Hey everyone, and welcome to this explainer. Today, we're unpacking a really critical provision of the newly enacted Income Tax Act 2025, and that is Section 166, which covers the reference to the transfer pricing officer. Look, whether you're a chartered accountant, a tax professional, a CA student, or a business owner dealing with cross-border operations, getting a firm grip on the exact mechanics of this section is absolutely essential for your practice.
So, picture this. Your client, or maybe your own business, is an Indian subsidiary, and you're routinely importing goods or services from a foreign parent company. We're talking millions of rupees crossing borders every single quarter. Now, you might be wondering, how does the tax department actually verify that the prices paid in these related party international transactions are fair? How do they know the prices aren't being artificially manipulated just to shift profits out of India? Well, that verification process is exactly what we're going to explore right now.
Here's our quick roadmap for today. We'll start with an intro to Section 166, then decode the legal provision itself, walk through a practical taxation example, cover the essential compliance requirements, look at some common practical issues, and finish up with a quick summary.
Okay, let's dive straight into Part 1, Intro to Section 166.
Right, so Section 166 is essentially the primary statutory engine under the new Income Tax Act 2025. That empowers revenue authorities to audit and figure out the arm's-length price of your international and specified domestic transactions. For the seasoned professionals watching, what you formerly knew and practiced for years as Section 92CA under the old 1961 Act, well, that's been comprehensively replaced. Plus, notice a massive foundational shift here on the screen. Those confusing dual concepts of assessment year and previous year are totally gone. Under the new 2025 Act, we simply use the tax year, which aligns straight up with the financial year.
Moving right along to Part 2, Decoding the Legal Provision.
First up, who's actually running this show? Under Section 166, subsection 17, a transfer pricing officer, or TPO, is specifically defined as a joint commissioner, deputy commissioner, or assistant commissioner who's been explicitly authorized by the Central Board of Direct Taxes to determine the arm's-length price. So these are highly specialized officers. They're completely distinct from your everyday assessing officer.
So how does this transfer pricing audit actually get triggered? It's a strict four-step chronological flow. Step 1. The assessing officer, during standard assessment proceedings, has to consider it necessary or expedient to refer the valuation. Step 2, and this is big, the AO cannot just act unilaterally. They are legally mandated to get prior approval from the principal commissioner or commissioner. Step 3. Only after getting that green light is the formal reference made to the TPO. And finally, Step 4. The TPO takes over jurisdiction specifically to nail down that arm's-length price.
Now here's where it gets really interesting. Under Section 166, subsection 5, the TPO is not just limited to what the assessing officer handed them. It's almost like giving the auditor X-ray vision. If they uncover other transactions during the proceedings, even if, let's say, the taxpayer conveniently forgot to report them in their accountant's report, the TPO holds sweeping suo motu discovery powers. They can just pull those hidden transactions straight into the audit, no questions asked.
But there is a vital exception to this entire process, a real game changer. If an assessee has validly opted for safe harbor provisions under Rule 105 of the new Income Tax Rules 2026, and the TPO has actually declared that option valid, the assessing officer is legally prohibited from making a reference under Section 166 for those specific transactions. So a valid safe harbor basically acts as an absolute statutory shield against a transfer pricing audit for those covered deals.
Now, if a reference is made, the clock starts ticking, and the timeline is highly regimented. The TPO kicks things off by issuing a notice to the SSE, demanding they produce evidence and their contemporaneous documentation maintained under Rule 89. After digging through the evidence and holding hearings, the TPO has to pass a written order. But here is the absolutely crucial procedural deadline you need to remember. Under subsection 7, the TPO must pass their order at least 60 days before the assessing officer's statutory limitation period for completing the assessment expires. This just ensures the AAO actually has enough time to incorporate the TPO's findings into the final math.
Let's make this concrete with Part 3, a practical taxation example.
Okay, imagine a scenario where an Indian manufacturing subsidiary imports specialized components worth 50 crore rupees from its foreign parent company during the tax year. That's a massive chunk of money, and they record this 50 crore rupees as an expense in their books.
Here's the step-by-step impact of Section 166 on that exact transaction.
The assessing officer refers this 50 crore import to the TPO. The TPO then scrutinizes the taxpayer's FAR analysis, the functions performed, assets employed, and risks assumed, and concludes that, hey, if these were completely independent entities, the price would have only been 45 crore rupees. So the TPO determines the arm's length price is 45 crore. Under subsection 11 of section 166, this order is binding. The AO is legally forced to compute the total income matching the TPO's order. This effectively disallows the excess 5 crore rupees of expense, which directly slaps an extra 5 crore rupees onto the taxable income of that Indian subsidiary. Ouch!
All right, Part 4. Essential Compliance Requirements.
Look, the absolute backbone of your transfer pricing defense is compliance. Under the Income Tax Rules 2026, Rule 89 mandates the strict maintenance of contemporaneous documentation. That means your local files and your master files. Then Rule 90 requires the filing of the accountant's report. Actually, under the new rules, this is known as Form 48. And this is a brilliant illustration of a major digital upgrade. Form 48 has completely shifted away from those old, messy narrative disclosures to highly structured, transaction-wise reporting with standardized dropdowns. It makes the data instantly analyzable by the tax department's algorithms. Also, just a quick note, if you're operating with an advanced pricing agreement, you've got to file Form 52 for annual compliance and Form 54 for your APA renewals.
Next up, Part 5, Common Practical Issues.
Now, what are the traps? Well, a huge pitfall we see is simply failing to hand over the required evidence to the TPO on time. If you drop the ball here, the TPO has the explicit power under Rule 105, Subrule 5 to invalidate your safe harbor option entirely. Your protection just vanishes. Secondly, some folks try to omit certain risky transactions from their Form 48. I literally cannot stress this enough. Omitting transactions does not hide them. Thanks to the TPO's broad suo motu discovery powers under Section 166.5 that we talked about, they will find them, and the penalties for non-reporting are severe. Finally, a super common transitional issue is confusing the new tax year compliance deadlines. You really need to make sure your internal systems are fully migrated to the tax year terminology to avoid late filings.
And finally, Part 6. Summary and Key Takeaways.
So, what is the absolutely crucial point of all this? Let's rapidly recap the 5 core takeaways you need to remember. First, Section 166 of the 2025 Act is the new sheriff in town, completely replacing Section 92CA. Second, an AO cannot just refer a case on a whim. Prior approval from a PCIT or CIT is absolutely mandatory. Third, a valid safe harbor declaration acts as a total block against an AO reference. Fourth, never ever omit transactions because the TPO has sweeping powers to assess unreported items they discover themselves. And fifth, the TPO is bound by a very strict 60-day deadline to pass their order before the AO's assessment limitation runs out. Keep these firmly in mind because just one missed deadline or one unreported transaction can change the whole shebang.
So, ask yourself, are your clients' transfer pricing strategies bulletproof against the sweeping new powers of Section 166? You really want to make sure they are. Thank you for watching. Please like, subscribe, and share. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.